What is the point of creating new content when it is already available on the IRS website? My aim is to interpret IRS laws in story format for a comprehensive comprehension to steer clear from confusion. My today's topic is about taxpayers can employ several tax saving strategies to manage their profit from flipping houses. I'm going to describe or explain in this program. If you are in a business when you flip houses, so what is the best strategy you can opt to reduce your taxes? This is Nashimur, the CEO of InfoTaxQuad.com. We are a team of CPAs and EAs. Greetings to those who are connected with my channel and greetings to those who have been using InfoTaxQuad.com for their business needs for years and years. I request attorneys, tax preparers, taxpayers, entrepreneurs, students, economists, and the most important, politicians who create laws to subscribe to my channel to receive the most up-to-date and accurate tax information to enhance their knowledge. There are some effective approaches which a taxpayer may opt or consider or contemplate when flipping houses. Number one, the long-term capital gains tax rate, which is generally lower than the short-term rate, can be advantageous to taxpayers who holds properties for more than a year before selling it. So the first strategy is if you hold property less than 12 months, you'll have to pay taxes on ordinary income, which is higher than if you hold property 12 or more months. Then you pay taxes between 0 to 20%. Number two, option number two, if you're in a business who flips houses. By using Section 1031 exchange, a taxpayer can delay paying capital gains taxes on the sale of a property by reinvesting the proceeds into another property of like kind. If you're exchanging property of like kind, then you can also postpone or defer your taxes. Number three, an installment sale enables the taxpayer to spread the recognition of gains over multiple years, potentially maintaining a lower tax bracket each year. You can also consider receiving your income in many years rather than in one and pay higher taxes. So installment is also one of the options available to opt by a taxpayer. It is important for a taxpayer to meticulously keep record of all home improvement and selling expenses as they can be deducted from their capital gains. A taxpayer can also take deduction for the improvements or for selling other expenses to reduce the capital gain. The benefits can be obtained by investing in a qualified opportunity zone, such as deferring capital gains taxes and exempting gains from taxation if held for at least 10 years. If a taxpayer has gain, he or she can consider investing in qualified opportunity zone. If a taxpayer invested for at least 10 years, it can be completely exempted. A taxpayer could consider using self-direct IRA to invest in a real estate, which can offer tax-deferred growth for even tax-free growth in case of Roth or traditional IRA. Retirement trusts are also one of the options to reinvest and reduce income, taxable income. A taxpayer has the option to invest in real estate through a self-direct IRA, which can provide tax-deferred growth, tax-free growth, if it is an individual's retirement account. And a taxpayer's real estate activities can be reduced by a 20% pass-through deduction under the Tax Cuts and Jobs Act if they qualify. This law came just a few years back only. So now let me explain it with the help of a case study for your comprehensive comprehension. In his spare time, Gary renovates and sells houses while owning his primary residence. Each year, he works on and sells around 2 houses. Sometime in a growing market, he makes a significant profit. So what is my advice for Gary as a tax consultant? If he is flipping houses every year or 2 houses, the cost of property improvement like adding a driveway or installing a bathroom is added to the cost of the property. The basis excluded the expenses of maintaining and operating property. Gary is obligated to pay tax on the capital gain of the home he renovates and sells. By categorizing costs and keeping receipts related to them, Gary can reduce his tax liability. Again, if a taxpayer who flips home and makes gain or profit, what he can do based on my personal advice or the professional advice. The cost of property improvements, like adding a driveway or installing a bathroom, is added to the cost of the property. The basis excludes the expenses of maintaining and operating property. That is different. So we have to categorize it in the capital gain and the operating expenses. So Gary is obligated to pay tax on the capital gains of the home he renovates and sells by categorizing costs and keeping receipts relating to them. Gary can reduce his tax liability. Thank you and God bless you.